Welcome. In this video, we're going to take a look at budget preparation. I want to differentiate budget preparation from budget utilization. Any company can prepare a budget, but not every company can utilize a budget, which we'll look at subsequently. That's the control aspect of planning and control. Okay, before we do so, we need to get a handle on what a budget is. In other words, we need to define what a budget is. I would offer that a budget is a quantitative expression of something we expect or desire to occur. Quantitative is the key term here. What we want to be able to do with a budget for control purposes is we want to be able to compare our actual performance with our expected budgeted performance. And as I said a moment ago, not every company is going to be able to do that. The reason is that depending on the nature of the industry in which the company operates, if that industry is relatively stable, then your budget can be it can be a tool that you can utilize for control purposes. But in many industries, the industry is so dynamic that your budget is a lot like a weather forecast. Okay, it's still useful from a planning aspect, but it's not reliable enough to use it for control purposes. Now, we budget for all types of things. The primary ways of classifying our budgets are into operating budgets, such as our sales budget, production budget, purchase budget, so forth and so on. And then we have our financial budgets, the most important of which is the cash budget, capital expenditure budgets, and then our financial statement budgets. This diagram here shows the way in which these different types of budgets interact. There's a couple things here that I would want to point out. Number one, this entire process starts with a sales budget. That's going to drive everything. It's going to drive our operations. It's going to drive our expected capital expenditures. That's the investment that we need to support those operations. And notice that while our sales budget drives all of this activity, everything ultimately flows into our cash budget, which is arguably the most important type of budget that we have. So here we're going to work through an illustration on some of these, some of the primary operating budgets as well as a cash budget. So as I said a moment ago, all of this is initiated by a sales budget, and I'd like to draw your attention to this diagram right down here. So when we talk about sales, we need to comprehensively understand that our sales could be cash sales and credit sales. If they're cash sales, obviously we collect them immediately and we collect 100% of them. So cash sales, that's done at the point of sale. However, if we have credit sales, there's a couple issues that we need to address. Number one, we may have offered sales discounts, which is an incentive to try to get our customers to pay quickly. So in this particular illustration right here, we're assuming that 40% of these credit sales will be taking a sales discount and the other 60% will not be taking a sales discount. Well, what's a sales discount? For example, 210 net 30. What does that mean? That means they get a 2% discount if they pay within 10 days. Otherwise, the net balance is due within 30 days. So obviously, this 40% of this 80% that we are expecting to take the sales discount means they will be collected within that discount period. 60% we're budgeting will not be taking the discount. So when will they be collected? Well, based on our past experience, we assume that 20% of those will be collected in the month of sale. That would be month 0. 50% in the next following month. That would be month 1. 29% in the second following month. That would be month 2. And notice that this does not add up to 100%. It adds up to 99%. So we are budgeting that we will not collect 1% of our sales. Now, I want you to note this is a nice little diagram to comprehensively capture the various different possibilities of what can happen with our sales. These actual percentages are not the same as what's going to be in the illustration that we're about to look at. Okay, so let's start up here with our sales budget. This is the beginning of our budgeting process. The first thing we would do is we would have a sales budget or a sales forecast. That is this row right here. And we've done that for the month of October, November, December, and January. In other words, these right here are quantities. Now, when we're working with these various different schedules, sometimes we're working with quantities and sometimes we're working with dollars. So I would be very, very careful to appropriately label them so as not to get confused between whether we're talking about actual units or whether we're talking about dollars. All right, so our sales in units for the 4 months that we're looking at here are laid out right here. Our budgeted sales price is $30 per unit. Our budgeted purchase price is $20 per unit. So we can take these sales in units and we can express them in sales dollars or in cost of goods sold. That's what we've done with these two rows right here. Okay, now what's going to happen to these sales right here? For example, in the month of October, we're expecting to sell 62,500 units for $1.875 million. As we've seen down here, we can expect that some of that will be for cash, some will be for credit. Of that that's on credit, some will take our sales discount if we're offering one. Some will not take our sales discount. And then what doesn't take the same, which doesn't take the sales discount will be collected over some kind of pattern. And if we do expect to have uncollected accounts, which would be the norm, then that's going to show up in here. Okay, so our first split on our tree diagram there that we just had a moment ago is what's going to be our percentage of cash sales and what's going to be our percentage of credit sales. Well, in this particular illustration, we expect of any given sale 20% to be cash, 80% to be credit. So from our sales forecast, we had budgeted $1,875,000 of total sales, of which we now estimate $375,000 to be cash sales and $1.5 million to be credit sales. Likewise, we would do the same thing for November, December, and January. All right, of the 375,000 cash sales we will collect in the immediate month, and we'll collect 100% of that, so we don't have to do anything else with that. Of the $1.5 million in credit sales, we now need to ask ourselves, essentially, when will that be collected and how much of that will be collected? Well, that $1.5 million of credit sales, we are estimating that 40% of that will take a sales discount, so that'll be $600,000. And the remaining 60% will not take a sales discount, so that'll be $900,000. Likewise, we would do the same thing for November, December, and January. Okay, for the $600,000 of credit sales that we expect to take a sales discount, that sales discount is 2%. So since we're assuming they'll take that sales discount, the net amount of cash that we will receive of that $600,000 will be $588,000. Likewise, we would do the same thing for November, December, and January. Now, what about the $900,000 not taking the discount? Again, we have two questions. When do we expect to collect that, and how much of that do we expect to collect? Well, based on our previous collection history, we expect to collect 50% of that in the month of sale. That's month 0. 30% in the next month. 17% in the second month. And 3% we are budgeting that we will not collect. So we expect to collect only 97% of that 60% of our credit sales, which was, I believe, 80% of our total sales. So of the $900,000 that we're working with in the month of October, we will expect to collect 50% of that in October. That's $450,000. 30% in November. It's $270,000, and 17% in December, $153,000. Now, if you work this out on a spreadsheet, it's very easy to total up those columns, which would be 973. Take that, divide it by the 900,000, and you should get 97%. In other words, of the amount that we're looking at here, we expect to only collect 97% because we're budgeting that we will not collect 3%. And likewise, we would do the same thing for November, December, and January. Now, what we're looking for in this particular schedule is this amount right here. This is the amount in December that we expect to collect of the 60% of our credit sales that do not take a cash discount. And we can do that for December and January. We can't do it for October and November because in order to do so, we would have to have information from the months preceding. Now, if we wanted to know what our budgeted accounts receivable balance would be for any time, here's how we'd go about determining that. And that's illustrated down here. So our budgeted accounts receivable balance as of 12/31 of the given year, so that'd be December 31st, is budgeted to be $1,141,920. Okay, so we have no accounts receivable are credit sales that have not been collected. So let's walk through this. First, all of our cash sales are obviously collected, so they're not a part of our accounts receivable. Credit sales that take the sales discount get collected, so they're not going to be in our accounts receivable. So the only credit sales that can end up in our accounts receivable balance, they must come off of this schedule right here. So in the month of December, we will have fully collected all of our October and previous sales. We have, of our November sales, we will have collected this amount in November, this amount in December. So we have this balance here that we expect to collect in January. And then of our December sales, we will have collected $900,000, which leaves us with the other $900,000. So this right here, this number right here, refers to the amount of our November sales that we have not collected, and this right here is the amount of our December sales that we have not collected. So question, why is that $241,920 and that's $205,632? In other words, this number right here refers to everything from our November sales that we have not collected. This refers to everything from our December sales that we have not collected. On this schedule right here, this refers to the amount of our November sales that we expect to collect in January. And my question is, why are these two numbers different? And the reason is because this right here is 17% of this amount, and this number right here is 20% of this amount. In other words, this number right here reflects the fact that we are expecting not to collect 3%. Until I actually write off those accounts, I will carry them in my accounts receivable. So this number right here is 20% of that number, whereas this number right here is only 17% of that number. The difference representing the amount of the 3% of this number, which I expect to not collect. Okay, once we've completed all of our sales collection schedules, which we previously did, we would move on to our production schedule. In other words, how much inventory are we going to need to have in order to meet our budgeted levels of sales? As I've previously stated, we can either have production for inventory or production for demand. In a job shop, it's most likely that it's going to be production for demand. It's going to be demand driven, whereas in a flow shop, it's most likely going to be a 24/7 operation where we just run 24/7, and we're producing for inventory. In this particular case, we're producing for demand, and we express that right here. Our desired ending inventory is 20% of the following month's credit sales. So in this schedule, note first off that we're working with units and not dollars. So what we're going to do is we're going to take our basic equation from a T account for inventory and rearrange that to determine the number of units that we need to acquire. So if we have a desired ending inventory, which is 20% of the next month's sales, well, how many sales did we budgeted to have in November? 84,000. So we want to have that much inventory on hand. How many sales do we need to have, or how much inventory do we need to have on hand to meet the budgeted sales for October? That was 62,500 units. So here's the desired ending inventory. here is our budgeted level of sales. This is the total amount of inventory that we're going to need. How much inventory do we have on hand? Well, my beginning inventory this month was my ending inventory last month. And my ending inventory last month would have been 20% of this month's budgeted sales. Well, 20% of this month's budgeted sales, which was $62,500, is $12,500. So this is what I need. This is what I have on hand already. So what will I need to purchase? 66,800 units. Okay. And then if in case I get a fractional unit, I'll need to round that up. And then what's going to be the dollar amount of purchases? Assuming a purchase price of $20, it's going to be $1,336,000. Okay, let's do the month of November. Over here in the month of November, I have a desired ending inventory. How much will that be? 20% of my December sales. My budgeted December sales is 125,000 units. So 20% of that is 25,000. That's what I want to have in ending inventory in the month of November. Then I will also need the 84,000 units that I expect to sell in the month of November. So in total, I'm going to need 109,000 units. How many units am I going to have on hand? Well, my beginning inventory in November was my ending inventory in October. That's what I need. That's what I have on hand. That's what I need to acquire, round it up, and that's what it's going to cost me, $1,844,000. And we would do the same for December and January. So we started this whole process with a sales forecast. Then we moved to our sales collection schedules. Now we're looking at a purchase or a production schedule. In other words, how many units do we need to purchase or produce? In this particular case, it's a purchase schedule because we're assuming we purchase our inventory instead of produce it. The next set of schedules that we'll look at is when will we pay for that inventory? So just like we had with our cash collection, or with our collections from sales, we have our cash disbursements for purchases. We could have cash purchases and credit purchases. In this example, I'm assuming 100% of our inventory purchases are done on credit. That's the typical situation. As with our customers, we offer them a sales discount. We would be most likely offered a purchase discount. Based on our past history, we would take some percentage of those purchases, would take advantage of that purchase discount. Some would not. In this particular case, we're assuming that 60% would be, 40% would not be. So of the $1,336,000 in purchases that we calculated in the previous schedule, we estimate that 60% of them, $801,600 worth, will take our purchase discount, and the remaining 40%, or $534,400, will not take the purchase discount. That takes the purchase discount. The amount of the purchase discount will be 2%. So what will we collect of this? We will collect 98% of that amount, which is $785,576. And likewise, we would do the same thing for these remaining months. Now we have the question of what happens with the $534,400. In other words, when do we expect to pay that? Well, based on our payment history of those purchases for which we do not take the purchase discount, historically we have paid 60% of those off in the current month, in the month of purchase, and 40% in the next following month. Okay. Here the assumption is, and again this would be the logical assumption, is we pay 100% of our purchases. So of the $534,400 of purchases, credit purchases in October for which we did not take a purchase discount, we will pay 60% of those in the month of October, 40% in the month of November. For the $737,600 worth of credit purchases made in November for which we did not take a purchase discount, we will pay 60% of those in November and 40% in December. Likewise, as we did previously with our cash collection schedule, we would total these up and calculate a percentage, take that total, divide it by that, and in this case it should be 100%. Why? Because we pay off 100% of our purchases. Then the numbers that we're interested in are these numbers right down here, because this tells me what my expected cash disbursements will be in the month of November for those credit purchases for which we did not take a purchase discount. Okay, these are just a handful of the different operating budgets we look at. But if you think about a company's income statement, what should be the largest items on it? Or more specifically, a cash flow statement. What should be the largest items on it? Well, once again, remember, all firms engage in three activities: operating, financing, and investing activities. And the bulk of what happens to a company should relate to operating activities. So if we're talking about a cash flow statement, then what should be our largest source of cash? It should be collections from sales. Well, we've just worked through that. What should be our largest cash disbursement from operations? It should be the purchase or the cost of producing our inventory, and we've just worked through that. Okay, our cash budget has 4 different sections: cash receipts or cash coming in, cash disbursements, cash going out. The third section would be a deficit or a surplus, and then the fourth section is how are we going to address that deficit or surplus? In other words, what are we going to do about it? For those of you that are familiar with a cash flow statement, a cash budget and a cash flow statement are essentially the same. Once again, remember, all businesses engage in 3 fundamental activities: operating, financing, and investing. So in terms of cash flows, whether we're talking about a cash budget, which is pro forma, or we're talking about a cash flow statement, which is what actually happened, the sources of cash are going to come from those 3 different activities, and the uses of cash are going to come from those 3 different activities. All right. Notice that in this particular example here, we want to maintain a minimum cash balance of $50,000. Don't ever forget, we're working with pro forma numbers. These are expected numbers. In other words, these are not certain numbers. So we want to make sure that we don't encounter a situation where we become illiquid, where we don't have enough cash on hand. The more faith that we have in our estimated numbers, and the greater our ability to coordinate what we're doing, the lower the amount of that cash balance should be. What's the problem with holding a large cash balance? Well, what's the pros and cons of holding a cash balance? The positive of holding a cash balance is I avoid the possibility of becoming illiquid, of not having the necessary cash on hand to meet my cash obligations. The downside of holding cash is that cash is a non-productive asset. Okay, so the first section here is cash coming in, cash available. We have our ending cash balance from the last period, which is $50,000. Then we have cash from operations. Well, cash from operations is going to be collection of sales. So we have, in the month of December, the cash sales we made in the month of December. That came off of Schedule 1A. We have the collections of credit sales taking the discounts for the month of December. That came off of Schedule 1C. And we have collection of credit sales not taking the discount. And that came off of Schedule 2, and that was $1,415,888, $1,415,880,000. In other words, this right here is the total amount of cash that we expect to collect from sales, which is essentially from operations. What about collection of cash from investing activities? Well, the sale of investments is an investing, or more specifically, it's a disinvesting activity. We're selling off an asset. And then financing activities. The issuance of bonds payable and the issuance of common stock are both financing activities and are both sources of cash. So the total amount of cash coming in, $3,491,880, combined with the existing cash balance that we had, beginning cash balance, gives us a total amount of cash available of $3,541,880. And that cash has come from the three possible sources of cash. Operations, that's this right here. Investing activities, that's the disposal of an asset right here. And financing activities. Okay, now let's look at cash outflows or cash disbursements. Once again, cash disbursements or uses of cash are going to come from those same three activities: operating, investing, and financing activities. So from operations, we have the cash disbursements that we've made in the month of December for the acquisition of our inventory. That's going to come off of these two schedules right here, Schedule 3B and Schedule 4. This is the amount of credit purchases taking purchase discounts, and this was the amount of credit purchases not taking the purchase discounts. Then we have our other operating expenses. So these three items right here constitute uses of cash from operating activities. Then we have our capital expenditures. That is an investing activity. Then down here we have our financing activities, notes payable. Well, what does this mean? This means we expect to pay back $165,000 in notes payables. Dividends is also a financing activity. So our total cash disbursements, $3,502,040. We have a desired ending balance of $50,000. So this is the total amount of cash we're going to need right here. This is the total amount of cash that we have available, what we had coming in, or what we expect to have coming in during the month of December, plus what we already had. And this is what we estimate that we will need in the month of December, the total amount of cash flowing out plus our desired ending balance. So in this particular case, we have a deficit of $10,160. So note, regarding this deficit here, we actually have a positive cash balance. The problem is it's less than our $50,000, which is our desired minimal balance. So what do we do? In this case, we can see that we're going to need to deal with that budgeted deficit. So we're going to have to borrow $10,160,000. Depending on what happened right here would determine what we end up doing down here. In other words, in this case, we have a deficit, so we need to finance that deficit. We need to go out and engage in, we need to go out and borrow money. What would have happened here if we would have had a surplus? Then we would look over here at what do we do with that surplus, which would be to pay down short-term debt, so forth and so on. So the net effects of financing is to borrow $10,160,000. That will leave us with our ending cash balance of $50,000. Okay, a couple questions for you guys. This right here is debt, and this right here is debt. What's the difference? Well, the difference is this is planned debt, and this is unplanned debt. As planned debt, I can secure this debt, and I can get a more favorable interest rate, so forth and so on. This being unplanned debt means I'm going to be borrowing money under the most unfavorable conditions. So this is an extreme view here, but I like to refer to this as like loan shark money. I do not want to find myself in a situation where I'm borrowing under these kind of conditions right here. And this is one of the reasons that we engage or that we prepare a cash budget, because if I can see right here that I'm going to have a deficit in the month of December, and I prepare this budget several months in advance, then what could I do? Well, I might be able to shift some cash flows around in order to avoid having to go out and finance that. Or if I'm not able to do that, I still, if I'm aware that I'm going to have to finance something in the month of December, I can set up better financing terms. Final question. Is it better to prepare this budget on a more frequent or on a less frequent basis? In other words, is it better to do it on a monthly basis, every 2 weeks, once a month, once a quarter, so forth and so on? It's better to do it more frequently. Why? Because if we do have to go out and borrow money, we're going to have to pay interest on that. And so obviously we want to have that debt outstanding for the least amount of time as possible. So I'll try to illustrate that, try to illustrate the point I'm trying to make here with the numbers that we're working with. So in this particular case, over a 1 month period in the month of December, we're estimating here that we are going to be short $10,160. So what are we going to have to do? We're going to have to go out and borrow that amount of money at the beginning of the month, and that debt will be outstanding for at least the month of December. Let's just assume, and I'll make this example as extreme as possible to illustrate the point. Let's assume that all my cash flows, all the cash coming in, occur throughout the month. But all of my cash outflows here occur on the last day of the month. In other words, this obviously couldn't happen, but I'm doing this to illustrate a point. So assume all of these cash outflows here happen on the last day of the month. So actually, we would only have a deficit situation for that last day of the month. So if I was preparing a budget for shorter periods of time, I might be able to borrow the money for shorter periods of time. So in the example that or this illustration that I'm kind of making up right here, assuming that we were aware that our cash, the timing of our cash flows were such that all of these cash outflows occurred on the last day of the month. So the only day that we would actually be short of cash is the last day of the month. And so we would only need to finance that for 1 day as opposed to the full 30 days that we would do if we were doing this on a monthly basis. Okay, that's it for budget preparation. As I said at the outset, any company can prepare a budget, and every company should prepare a budget. A budget can be a pretty solid forecast of what you expect to happen, or it could be nothing more than a guesstimate. It depends on the nature of your industry. In the past, when I've taught classes like this with executive MBAs, and we've gotten into talking about budgeting, a lot of the students that I've had have been in industries that are so dynamic that they say, we're modifying our budgets almost on a continuous basis. So our budgets are nothing more than guesstimates, and that's fine. But the key point here is that while every company can prepare budgets and should prepare budgets, not every company can utilize those budgets for control purposes, which is what we will talk about in a subsequent video. All right, that's it.